Hello, good afternoon, everybody. Charlie, welcome. Thanks for joining us again.
Thank you, Caleb. Hi, everyone.
Yeah, we've got a great session today. Inflation-proof strategies for maximizing returns. If that doesn't get your attention, I don't know what will. We also have Charlie's promised that he'll tell us in this webinar how to make sure that we have the next Nvidia in our portfolio. So,
Absolutely. Stay tuned to the end.
so we'll hold you for that one, Charlie. But
Yeah,
here's the
low
full
bar.
agenda. So we're going to talk about single best hedge against inflation. We'll talk about living in a higher for longer world, politics in your portfolio, mean reversion, whether or not that's dead. Next, Nvidia, as I mentioned. And then we'll talk about some charts to watch for the second half of the year. So very excited about that. Before we jump in, I guess a few housekeeping items. If you don't already know Charlie, if this is your first time joining a webinar with us and Charlie, you should definitely be following him on Twitter. Charlie has always the best insights, the best charts, and just great information all around. So follow him there. Um, you can also subscribe to our YouTube channel. So any webinars like this, as well as our other webinars that we do here at YCharts are on that YouTube channel. So hit the subscribe button. You'll get a replay of this one available on there tomorrow. I think that'll also get sent around to anybody that registered. But that YouTube channel is the best place to keep an eye on for content like this. If you have questions as we go through today, please submit those. You can do that right in the Zoom webinar chat feature, and we'll do our best to take as many of those as we can at the end of our session. And lastly, please remember that this webinar is for educational and informational purposes. Nothing that Charlie or I are saying today is intended to be investment advice. But with that, let's go ahead and jump in. So first section, and Charlie, I'm excited to talk about this because I don't know if you remember, but we did a webinar, I think it was in April of 2022, right when the Fed was in the kind of early stages of their rate hike cycle. And we had a topic whether or not the rate hikes were going to kill the bull market. I don't think that's happened since since April of 2022. I think I actually checked S&P 500 is up about 25% since then. And the inflation hedges that everybody loves to talk about, gold and Treasury inflation protected securities pips are up, I think about 18% and down 5% respectively. So, I guess plug the advice that you gave, 2 years ago has been pretty good, but let's get into what's changed between now and then and what you're thinking about going forward.
Yeah, awesome. Absolutely. So this chart, I think, tells the story. We're looking at the number of months consecutively we've been above 3% inflation in the US. And if you look at polls of sentiment, if you look at polls about the economy, this is the chart that's driving it for US consumers, US populations. Americans really, really hate higher prices. And the fact that inflation's come down is a great thing. It was 9.1% in the middle of 2022 when we had that webinar. Today, it's a little bit above 3%. That's great. Hopefully, it goes below 3% at some point in the next year. But people are feeling that cumulative effect of inflation and they really don't like it. So 38 consecutive months above that 3% level. That's the longest stretch of above elevated inflation we've seen since the late 80s, early 1990s. So it's still front and center, I would say, Caleb. And the question, of course, from an investment standpoint is always, well, how do I protect myself? If you have just money sitting in the bank in the past few years, it's losing value every single day because it's losing that purchasing power. The value of the dollar is going down month after month because the inflation is going up. So that same dollar is worth a lot less than a few years ago.
This depicts that in a very dramatic way, but the stock performance next to that is also pretty impressive, right?
Yeah, it's pretty incredible. You look at the red line there and you're like, wow, God, I lost half of my purchasing power over the last 30 years. And this wasn't a period of huge inflation, right? You're talking about like 2.5, 3% inflation in the past 30 years every year. Compound that, you're losing half of your purchasing power as a consumer. So clearly leaving your money in a checking account or underneath your mattress, it might feel good, not the best strategy. The S&P 500, of course, not just keeping pace with inflation, but exceeding it, up over 900% on a real basis. And after inflation, that's about 8% per year, which is kind of incredible performance. But if we look historically, since 1975 here, looking at about 50 years, well, how has inflation impacted various asset classes, and what has been the best hedge against inflation in the long run? It's been the stock market. You can see that there on the right side. The S&P 500 is done on a real basis over 8% per year, which is much better than, let's say, if we look at a 100-year period, it's much closer to, let's say, 6 or 7%. So last 30 years have been very good for the U.S. stock market. But you could see higher than REITs. REITs would be number 2, real estate investment trust there, 7.6% after inflation. Then we have investment grade bonds, 3.6% per year after inflation. And then gold, which probably surprised a lot of people because that's usually the first asset class people think of when it comes to inflation, outpacing inflation by 1.6% per year, but lowest of the major asset classes.
And also just running off the shelves at Costco though, in gold bar format.
Yeah, it's kind of incredible. I don't. Did we talk about the last webinar? But
I don't
here's
know if we talked about that part, but
yeah, I mean, it's just unbelievable because Costco has been one of the best performing stocks in the last 30 years, and they're buying these gold bars, selling out so quickly. If they would just have bought Costco stock instead of these gold bars, you're talking about like 100x differential in terms of what
and a
they
little
would
more
have.
liquid after the fact too, right?
Yeah, just a little bit. So a compounding machine has been Costco, and they could sell pretty much anything at their stores, and people love it. And gold bars, being just another example. It's kind of weird. Why would you sell? Why would you think gold bars would sell? But there's a market for everything, Caleb.
Indeed. But this chart looks at, more recent bias, right? And shows, a couple asset classes that are outperforming and a couple that are, maybe just slightly underperforming that
Yeah,
CPI.
so here's the bigger point here, right? We showed that long-term chart, the 30 years, right? And clearly stocks, 30 years, 50 years, 100 years, stocks have been the best. And that's simply because earnings growth, dividend growth has been there the last 100 years, and that's outpaced, things like gold, it's outpaced things like bonds, that equity risk premium, the fact that prosperity has increased, you've benefited that as an index fund investor. But that's not always the case. If you look at short periods of time, there will be times where gold is leading things. It will be times where bonds are leading things. There will be times where stocks leading things. And if we look at the last 4 years, that's when inflation started picking up, Caleb, in the middle of 2020. You can see here kind of a reasonable dispersion in terms of performance. So bonds this time around, not so good. And we know the reason for that. They were at all-time lows when this started in terms of yields. That rise in interest rates really hurt bonds. So we showed that chart earlier. Bonds have historically done a few percent above inflation, not this time, definitely below inflation, actually losing money. And you could see gold and real estate right around inflation. So cumulative inflations have been around 20 something percent here over this period of time, 22%. And you have gold and real estate right around that in the stock market. Most of these gains coming in the past year and a half. You can see that if for a while there, stocks were right in line with inflation after that 2022 bear market, and then just rip roaring from there. So I think the broader point here on inflation, what's the single best hedge? It is the stock market, but a diversified portfolio gives you kind of the best odds over rolling periods to not deviate too much in either direction, right? So we had a period from 2000 to 2010 where the S&P 500 was down, and you had inflation of 2.5 to 3% per year, right, during that period of time. Well, you're not keeping pace with inflation during that 10 years. And then we have gold from 1980 to 2000. I don't have that chart in here, but it's a really telling one. Gold was cut in half, of course, and you have inflation obviously each and every year from 1980 to 2000. So there can be very long periods of time where various asset classes don't keep up with inflation, which is why diversification wins in the end. And just being an investor, why you need to invest is because of that first chart that we showed in terms of the dollar is going to be worth less 10 years from now, 20 years from now. We just don't know how much. So if you need one reason to invest, just keep looking at that chart. We don't know if inflation is going to average 2%, 3%, 4% over the next 30 years, but it's going to be higher in terms of prices in the future than today. And the best way to protect yourself against that is to be an owner of assets, and cash flowing assets have done the best historically. And if you have a positive outlook on the future, you'll likely think that will continue to be the case. But diversification is the name of the game when it comes to having that confidence.
Yeah, it's a great point, Charlie. I was about to ask because I'm thinking back to that same webinar we did, a couple of years ago, and you had a chart that showed the Fed hike cycles as well as the cycles where they were cutting rates. And I think the caption was "Be careful what you wish for," because in those times where the Fed's been cutting rates a lot, typically we've seen declines in the stock market kind of alongside those rate cuts. If the Fed does get into a cut cycle, are you less bullish on stocks at all, or are you?
It depends why, right? All else equal, no. Right? Like historically, there's almost no difference between various S&P 500 returns when the Fed's cutting rates or hiking rates. That probably surprised a lot of people because the assumption always is easy money's good, tight money's bad, right? But the data doesn't really bear that out. And as you said earlier, S&P 500, since we started hiking rates in March 2022, S&P 500 is 25% higher. So we're right in line, right? That's a little over 2 years, right in line with historical returns. It's almost like it didn't matter at all. We know in between there was some trouble. We had a bear market, but if you look at where the Fed funds rate was essentially at zero back then, today it's above 5%, and the stock market's 25% higher. So what gives, right? So every time is different. Interest rates are important, but you have to know why they're moving, Caleb. So if they're moving lower like they did in 2008 and 2001 because we're in a recession and earnings are going down, well, stock market's not going to like that, and everyone is going to be cheering, okay, there's easy money's coming, easy money's coming. No, it's a problem because earnings are going down, and it's not a great thing that interest rates are low. So for a long time, 5% interest rates, as we'll talk about here, was nothing to write home about. It was not a big deal for markets. And today, of course, we're just so used to really low rates that it seems like a shock.
Yeah, it's a nice transition into this topic. We're talking higher for longer. I think we're talking about rates being higher for longer. We'll leave all the extracurriculars for a different time period. But Charlie, you've been, I think maybe a little critical of Fed policy in the past, and when we were talking about inflation, and Fed was saying it was transitory and they were slow to hike, and then when they started hiking, and then said they were going to start cutting rates, I think you were a proponent, or where it was like middle of last year, saying, let's not cut rates, let's wait, let's see what happens. So have you been pleased with the policy so far, where they've yet to cut rates and held steady for the most part?
100%. I give credit where credit's due. They've stuck to their guns. Powell said he's going to keep at it until the job is done. And clearly, looking at that chart earlier, the job's not done. We're looking at 38 consecutive months above 3%. Their target's 2%. You don't have to be a math wizard to say we're not there yet, right? So, and never mind the cumulative effect of those prices, right? So the point I was making too, Caleb, is just because we get back down to 2%, that doesn't mean that all of that excess inflation has been taken away. So my preference would be keep rates higher for longer until you have a real reason to cut. Of course, my bigger preference would be the Fed get out of the rate setting game. We shouldn't be letting them set interest rates. But if they're going to be setting interest rates and inflation is the bigger concern, why do you need to cut rates? You got stock market hitting 30 all-time highs already this year. You got housing market at all-time highs. You have crypto going crazy. You have meme stocks back in the news, roaring kitty, everyone following his every move again. It feels very much like before the Fed even started hiking interest rates. So why in the world, what's the urgency to cut rates? I don't see it. And so I'm glad they've pushed that back. And the expectation is now September. Coming into the year, people were saying 6 to 7 cuts this year. That's what the market was saying. Now the market's saying 1 to 2.
Yeah, it's interesting how everybody was so confident, right? It seems like along with all of the meetings and the notes that come out of those meetings and the opinions of each member of the Fed, everyone seems to be more confident what's coming next, but it's been a little less transparent than what we expected. So
Yeah, so you have to throw out pretty much any forecast that the Fed makes and what the market makes when it comes to interest rates, because they don't know. And if you look at their forecast back in 2021, when inflation was just about to spike to its highest level since the early 1980s, they were essentially saying no hikes for the next 3 years. They were saying we're going to just stay at 0%. So they didn't see the biggest spike in inflation since the early 1980s coming at all. So we shouldn't expect them to see what's going to happen next. And so I guess the way they're doing it now is the best way that a human being could do it, which is just react to the most recent data point. And if the data points change, you change.
yeah. Anything on PCE in particular here on this chart?
So yeah, this is the Fed's preferred measure, so-called, of inflation. They like to take out things like food and energy because you don't need to buy groceries, you don't need to fill your car up with gas, so those things don't matter. So they like this core PCE metric, and it just so happens pretty nice that PCE tends to be lower than CPI the way they calculate it. So that's kind of nice for them to use that as well. And if we look here, though, Caleb, the big thing to note here is the gap between that blue line, the Fed funds rate, and that core PC. And as you'll notice, since the financial crisis, most of the time that blue line is below the red line, meaning the Fed is maintaining easy money policy. You could see a brief period there in 2018, 2019 where we went above it, and then the Fed starts cutting rates again, and then obviously 2020 moved back to zero. But the past year now, we're in restrictive territory. And that's a good thing. And it takes time for this to work. So everyone's saying, like, why wasn't inflation coming down right away when the Fed started hiking? Well, that's not the way it works. They moved from zero to a little bit above zero. That wasn't going to have much of an impact. Now it's having an impact, right? We're seeing higher rates in terms of auto loans, of mortgage rates, of credit card rates, as we'll talk about. All of those things are starting to have an impact. And this is the biggest spread we've seen since 2007. The longer you keep it here, the more impact I think it'll have. And the impact it'll have is it brings down demand. So any good that you need to finance, it's going to be harder to do so. So all else equal, demand is going to be lower during that period of time. But the big question going forward, Caleb, is when that next problematic period comes, are they going to go right back to the easy money ways of the post financial crisis period, or are they going to go back to like pre-financial crisis where easy money was maybe a little bit below the inflation rate or at the inflation rate and not going straight to zero?
Yeah. I know enough about our charts to know that those gray lines on here indicate a recession. And it doesn't take a super keen eye to see that pattern though, where when that spread where target Fed rate is that far above core PCE, soon after we're seeing those gray lines. Is that just kind of self-fulfilling, like it's going to happen eventually, or do you think that spread is a worrisome indicator?
Yeah, that alone, I would say go back, look there in 1995. Look how long it took there before we
Yeah.
got to a recession. So like that alone is not predictive, but I would say that combined with the yield curve, which is still inverted, combined with a number of other indicators, these are long leading indicators of a recession. So they could take a few years. The yield curve's been inverted since October 2022, so we're almost at 2 years, and that's kind of the average length between the start of an inversion and the start of a recession. But we've seen it go 4 years, 5 years. So no, I think it's some of it's correlation versus causation, right? So the Fed is hiking rates when times are good, when the economy's running hot, right? And then what follows the economy running hot? Well, a slower economy at some point, and at which time the Fed will start cutting rates. So will this cause a recession? It has many times in the past. A recession has followed a rate hiking cycle of restrictive monetary policy, but the timing of that really is questionable. It could happen next month. It could happen next year. It could happen a few years from now.
Speaking of maybe troublesome indicators or things that are a little concerning, other rates are high too, right? So here we have credit card rates, but other consumer rates are starting to really take off.
Yeah, this is kind of a tale of two cities in terms of high interest rates. If you don't have any debt, if you don't have any floating rate debt, or you're just locked into a very low interest rate mortgage, that's all you have in terms of debt. You have no credit card debt. You don't have any floating debt elsewhere. You're likely feeling pretty good because you have cash savings account where you're earning above 5%. Got that fixed mortgage rate. Your earnings are going up. Your wages are going up. You're feeling pretty good. Now, the opposite end of the spectrum here is people who hold credit card balances, and those people are feeling pain. You can see here over 21% in terms of the interest rate. That's a record high with data going back to the 1990s. And what we're seeing, Caleb, very slowly each and every quarter when they report this data is a rise in credit card delinquencies, a rise in auto loan delinquencies, and so on and so forth. Nothing huge, nothing you would say, oh, this is problematic, right? But if that trend continues, the longer this stays higher, the more problematic this becomes for this group of people. So, first thing, financial advice 101 is if you have credit card debt, try your best to pay that down, especially when you're talking about 20% interest. It's the highest return you can get by paying this off.
I guess this kind of takes the individual debt and more on the public side, right? So the expense of that debt, and I think this was even maybe accentuated in that letter that recently was surfaced that Elizabeth Warren wrote to Jerome Powell saying, "Hey, let's cut rates," and this was one of the reasons cited there, I think, right?
Yeah, the government doesn't want higher rates because higher rates means they might have to slow the rate of spending. So they would much prefer the Fed to cut rates for a number of reasons, especially people that are in power now, to keep things going, right? To so-called extend and pretend. And for a long time, this chart was the saying when people looked at this chart was, well, that doesn't matter. It doesn't matter if we're at 20 trillion or 30 trillion because interest rates are so low. Now, very different story. So very quickly, you could see what happened when you go from 0% on the debt that we're paying to over 5%. And we're still adding $2 trillion to that debt level every year, by the way. We're fast approaching 35 trillion. Well, this starts to become a real problem. And so the big question is, and we don't know the answer to it yet, Caleb, is there going to be more pressure coming from the government to say to the Fed, you got to bring rates back down. We just can't handle this. If this continues out at this pace, it's going to surpass Social Security as the largest line item in the budget. So that's the danger, right? It'll start crowding out other areas where you want to spend money on programs like Social Security and Medicare, where we're clearly not cutting those programs. Well, is this going to put pressure on the budget? So far, no. And the reason for that is the answer is we're just borrowing more money. So we're borrowing more money to pay the interest on the money that we borrowed in the first place. And that can continue and continue and to continue until it reaches a breaking point. And what I would say is we're not close to that breaking point right now because this is not one of the top few issues, I would say, if you're looking at the election coming up. I don't see this on anyone's list of let's say, top three issues.
Yeah, and Charlie, I haven't been following as closely. Yeah, I was in the bond market a long time ago, but are we still seeing the same demand for treasuries at auctions, or is this starting to impact that?
Well, it's just clearing at a higher rate, right? It's just, it certainly had an impact in terms of you flood the market with as much supply as we have over the past few years, and you're going to have to offer a higher yield to get the same type of demand. So there's definitely demand, right? And so there's many different participants in the bond market, and some of them have to buy
Yeah,
this debt, right? And so there will always be that type of buyer. But if you let the free market do it and you don't let the Fed control it, where will this be, let's say, in 10 years? That's the real question. So is the Fed going to follow, let's say, the Bank of Japan, where they say, we have to really monetize this debt and just take over the bond market in terms of keeping interest rates low and buying the debt that's come out? It doesn't seem like they're doing that right now, but Well, I think, like I said, I think there's going to be more and more pressure for them to do so. I personally hope they don't do it. The only thing holding people back from really going crazy in terms of spending and borrowing is the fact that interest rates are high, right? If they were at 0%, you'd really have a call say, like, let's do another few trillion. Let's get another
Yeah,
stimulus going.
indeed. Well, speaking about politics, it's an election year. Every time it's an election year, so I think our third one, since I've been doing these types of things at YCharts. Everybody wants to talk about how risk is elevated. It's a dangerous time to be in the markets. Um, historically, that's not true, right?
It's not. It doesn't stop anyone from saying it. Unfortunately, you see headlines like
It's
this:
going to be different this
presidential,
time, though.
yeah, presidential election years are bad for stocks. Okay, well, how so? Please show me the data, because I went back to 1928 and found that presidential election years are up 10% on average versus 9.7% for non-election years, and this has been the best start to an election year in history for the S&P 500. So clearly not not hurting. And if we go back even further to 1860, Vanguard has this data showing 60-40 portfolio actually better in a presidential election year than non-presidential election year. So the saying is kind of I get it. I get why people are nervous about it, because they say, well, there's this uncertainty. I don't know who's going to be the next president, and therefore that uncertainty should be bad in their minds for the stock market. But the stock market thrives on uncertainty. There's always uncertainty. There's always risk. And thank goodness, and here's my broader point on the election, thank goodness the president of the United States doesn't dictate everything in terms of the stock market. They have actually very little influence, I would say, in those 4 years over the stock market. Now, that doesn't stop them from taking credit for it when the stock market's up or when the stock market's down, saying it's someone else's fault. But realistically, we have a checks and balances in the United States, and whoever is the next president of the United States, thankfully, it's not just that one person. We have a $26 trillion economy. We have many diverse industries. We have a huge private sector. The president of the United States, of course, they can enact policies that would be on the margin better or worse, let's say, for the business community and for stocks. But who that president is isn't going to be dictating what the stock market does.
This is a little unprecedented where we've got two candidates that have already been president, where, you may have a glimpse into, maybe not just the president's impact, but their party or, the people that they're going to bring in to help run the economy. Does that change your view at all?
Well, look at the returns. They both have positive returns. So if you're just going based on that, you would say I'll take either one. This is a great visual YCharts put together in terms of the election, with a lot of good data points. And you can see here, I'm looking at here, with the exception of Bush there, who was president during 9/11 and the global financial crisis. So the timing of that was the absolute worst, right? And I guess you could say it was his fault, but I don't think so. Right? Just blaming one person, but the rest of it, you could see the red presidents, the Republicans returns have been fine, Democrats returns have been fine. Overall, it's just a non-event for an investor. It's very easy, if we're looking at confirmation bias and all the biases we have, it's very easy and tempting for people to say, if you're a Republican and a Democrat is elected, let's say when Biden came to office, oh, things are going to be bad. And the same thing with Trump when he was elected in 2016, things are going to be bad. I'm going to sell all my stocks. That hasn't been the case. That doesn't mean that there won't be a negative return in the future. There will be, but it's unlikely to be just because of that president's policies.
Here we've got,
And
I guess, more just the overall kind of party. Um,
yeah, this is the broader point, right, Caleb? Like, if you sit out one party, you sit out another party versus just a steady buy and hold, you're going to miss out, right? Because the stock market tends to go up over time. This is not uh, illustrating anything other than that. If you sit out for just the Democrat years or just the Republican years, you're going to have much lower wealth over a 20-year, 30-year period.
yeah. All right. And you mentioned, this is the best start to an election year ever, right?
Pretty remarkable. You could, and nobody predicted this going in, as we'll show on the next chart. But here, 14% gain the first 114 trading days of this year. Best start to election year in history. One of the best starts in general. You can see not many too much higher than that. And yeah, we still have more than 6 months to go.
But everybody knew this was coming.
Yeah, right. You and I showed this this chart for 2023 in our last webinar, showing kind of how it was amazing because it was exactly the same. The S&P 500 finished well above every single Wall Street target from last year, and then what we said back then, and this was, I think it was in January, we said the most bullish thing that you can point to for this year is the fact that these strategists, after a year like last year where the S&P 500 was up over 20%, their prediction for the S&P 500, look at that average target there, 48.61, which is like a gain of 1 to 2%, which was very unusual. Usually when you have a really great year, everyone thinks that that'll continue. That wasn't the case. So the S&P 500 is already about 15% above that average target and above every single Wall Street strategist prediction entering the year. And the funny thing about this, Caleb, as you know, is all of these guys now are scrambling to raise those targets,
Or
right? And it's by the end of the year, their final target will be magically right at the S&P 500, but of course, not very useful. If you're a client of JP Morgan and you had that 4,200 prediction, well, what are you doing with that? I don't
right.
know. Hopefully nothing. Hopefully they did nothing with that.
Hopefully they were still long. Yeah.
Correct.
Well, I mean, that kind of leads into this topic too, which is, mean reversion. And I know we're going to spend a little bit more time talking about, large versus small and value and growth and international versus domestic. But, I think we got into this again, what was it, maybe a couple of years ago where, we were saying, hey, any opportunity where, you can buy a dip or see a pullback, it's a good chance to flip a position. But hasn't really held up, right? The last year or so, what's running has just been running, and that those spreads keep widening.
The secular trend reversed a little bit. You can see that small cap to large cap there when it reversed there. You could see that sharp move lower and
Yeah.
then boom, right back. And now it's highest since, I just updated this today, highest since November 1999. So this is going back, late 80s, this ratio on the top panel there, with the exception of 1999, right before the dot-com bubble peak. We haven't been higher in terms of large cap outperforming small cap. And so the question, Caleb, is twofold. One, that of course, is mean reversion dead? If it's dead, then this doesn't matter, right? Then you could say it could just keep running, and certainly it could, or it could keep running for the next 20 years. But if you believe that these things tend to mean revert, and that large caps now, if we look at the valuation spread between large caps and small caps, it's getting wider and wider. So people are more optimistic about large caps because they've done well and they're paying up for them. If you believe that matters, like it did in 1999, then you would expect some type of mean reversion, but we just don't know when. And I want people to look at that bottom panel right there because I showed you what happened in the 7 years following that November 1999 level that we're at right now. And you could see Russell 2000 was up, small caps were up 90%, S&P up 10. And you could see just what happened from 2000 to 2002. Of course, it took large caps down over 50% during that bear market before this time period. So it isn't the case. It may feel like it, but it isn't the case that large caps always and forever have outperformed and will outperform. There's a cycle to everything. And that's the question you have to answer. Is mean reversion dead? I don't believe it is. If it's not, then you still want something other than large caps in your portfolio.
Yeah, I think last time we were talking about how holding energy in your portfolio for so long was just a drag, and eventually that did kind of pay off here. And I think energy is actually still the leading sector of the last few years, right? If you break it down, if you go
Yeah,
back,
at the absolute worst, right? When everyone was throwing it out in 2020, when crude oil went negative, it became actually an attractive position to hold. It was one of the few things that did well in 2022. It was a pretty good inflation protector during that year when you had crude oil spiking. But Uh, yeah, look at this as a
But it's
reflection
no
of our.
match for the big tech companies, right?
No, yes, no, no energy company holds a candle to these three. So now this is breaking news, Caleb. You're getting it live here first if you're watching this, unless you were glued to your computers right before this and looking at it. So I just tweeted this out that Nvidia has surpassed Apple and Microsoft to become the largest company in the world. And 10 years ago, Caleb, the market cap of Nvidia, I could have you guess, but I think it would be so difficult. I won't even put you on the spot to do it. At a $10 billion market cap 10 years ago, now we're at 3.33 trillion. That's a 300x increase in 10 years. We haven't seen anything like that historically. And here, I'm going to give you a crazy stat here. All of these three companies, each one of them is above 3 trillion. The total market cap of all of the companies in the Russell 2000 is lower than these three. It's around 3 trillion exactly. So pretty
Wow.
remarkable. That shows you it's been a large cap world, and the small caps, just that lag has really persisted for so long that you have this case that there's three companies that each have a bigger market cap than the entire small cap universe in the US.
That's incredible. I think real quick, we were also going to do a poll here, right, Charlie? I think this is a poll that
Yes,
you asked some folks on Twitter, maybe
I
a little while
did.
ago, right?
Yeah, I'd love to see how it differs, if it differs at all. So the first time in history, there's three U.S. companies with a market cap above 3 trillion. That's Microsoft, Apple, and Nvidia. And what do you think will be the first to hit $4 trillion?
All right, so we'll give everybody a chance to
I
fill that
guess
out.
at
Well,
the
I
current pace, that might not take that might not take too
was going to
long.
say
Who knows?
maybe 15 minutes ago we would have got
Right,
a
I've already
different answer
passed
than
it.
what we
Yeah.
did now.
You have any thoughts, Caleb?
It's hard to argue with Nvidia's momentum. I'm going to stick to my answer last time you said this though, and ask me this. I'll tell you why charts were on the
There
move.
you go. Okay, I like it. Sleeper prediction.
Just a couple of years.
That's right. So
How does this make you feel, though, Charlie? Are you one of the people that think this is a concern? It's oversaturating index positions. It's monopolistic. What are your feelings on companies of this size?
yeah, it's all the above. It's the monopoly stuff is clear, right? It's the government's going after a whole bunch of them. We'll see if they succeed or not. But these have been monopolies. What I've argued is these have been monopolies that people have liked and benefited from. So it's not the case that most people don't like the Amazon monopoly or they don't like the Apple monopoly. Like there's certain features and things perhaps they don't like about it, but for now, it seems like for the most part they actually like it, which is why it's taken. I think it just continues to grow because they're providing such a valuable service to so many people, and these are products that people use every day. And is Nvidia a monopoly? It's got greater than 90% share, but there's nothing to suggest that someone can't come in and come up with their own product. The thing is, they're way behind the curve in terms of R&D. But all of these big companies, Apple, Microsoft, Amazon, they're all spending a ton of money, as you might imagine, to try to come up with their own chips for the AI build out because they're spending so much billions of dollars to Nvidia coming from these big companies in the AI data race. Okay, so we got some results here. 52% Nvidia, 29% Microsoft, 14% Apple, and 5% some other company. I think that's in line with what
I
I
think that
saw on
mirrors pretty
Twitter.
well what you saw last time, right?
Yeah. And that's not a bad bet. It's like when you're a kid and you ever play the stock market game in school, which is such a ridiculous game to play because it doesn't teach good habits whatsoever because no one's picking a diversified portfolio, and you shouldn't for that game. You should find the most volatile stock you can find and put everything in that stock to try to win that game. You're either be the worst performer or the best performer. And since Nvidia is the most volatile of these and has the most momentum, it probably is the most likely to hit four. I guess maybe a better question would have been 10 trillion something way out in the future, right? Versus four. But okay, we'll see. perhaps by the next webinar,
Still
one of these
another
will have hit it.
30%. Yeah.
Yeah. Yeah.
But
Still
that leads
right.
to the
Just
question, right? Which
it's
is,
like a
should
good
I
week
have
for
more
Nvidia.
Nvidia in my portfolio?
And that is the question every advisor, if there's any advisors on this call, they're probably hearing that ad nauseum. And what I would say and what they should be saying is you already have a good percentage in your portfolio if you're an index investor. If you look at the top 3 holdings in the S&P 500, there's a record 21% are just in those 3 names, Microsoft, Apple, and Nvidia. So Nvidia is about 7% of the index right now. It's kind of crazy because 2 years ago it was 1%. So you've benefited from that rise in Nvidia. If you're an index investor, you just didn't benefit like you would have if you owned nothing but Nvidia. But that's always the case if you take the best performing company and say I could have put everything in it. And the risk, of course, right now in saying I'm going to overweight or put more in it is, okay, we're at some type of extreme where we showed that ratio of small and large. What if it reverts in the other direction? And you can see the leaders change over time. Look in the early 1980s, you had ExxonMobil and AT&T and IBM, and they tend to change. And there will be new Nvidia in the future. You just don't know what it is. But I think we're going to talk about that in a little bit. So let's save that.
Yeah, we'll save the secret. But I guess the next factor, discrepancy here, growth versus value, right?
Yeah, very similar. If you're noticing a theme here, it's very similar to the large and small, and because many of the big growth stocks in the Russell 1000 are the Apples, the Microsoft, the Nvidia, and so on, right? And we talked about this in 2020. It looked like we were going to get a mean reversion. Seemed prudent to add some to value at that point in time. It did work for 2 years, and then you could see just that reversal like coinciding with the AI revolution that we've seen, reversal, and now we're at the highest levels since July 2000. And if we look out 7 years from July 2000, like we did with small caps, well, what happened the last time we were at this stretched level in terms of growth and value? Well, the next 7 years look very different. You had value stocks up 84%, growth stocks down 27%. So again, the question is mean reversion dead? If it's not dead, then at some point it will pay to have some value in your portfolio. But we're looking at the longest period of outperformance from growth that we've ever seen. You're talking about 15 years of outperformance.
Yeah. And speaking of long outperformance, here's the SP 500 compared to the rest of the world, right?
Yes, indeed. USA. We got the 4th of July
Coming up.
coming up soon. Fly that USA flag if you're US stock market investors. Nothing close to it over the last 16 years now of outperformance. You can see that trend pretty steady up and to the right in terms of outperformance. Wasn't always the case. You could see historically it would move one way, it would move the other way. There was this mean reversion concept. Not so in the last 16 years. We're now 3 standard deviations above the mean going back to 1970. So this is stretch similar again. Same. What's driving U.S. outperformance? Large cap U.S. growth stocks. So it's all kind of the same trade a little bit, which is yet another reason why you want to be diversified, because a small percentage of stocks are driving a lot of these relationships.
Yeah, I guess. Well, this chart kind of shows it, right? But even in more recent times, last 16 years, diversified one thing, but I mean, there's been one dominant player, right?
Only one, yeah. Look at 457% versus 96% for all international stocks, and just 48% for emerging markets. Not even close. And we've never seen this type of disparity historically. And some of it's fundamentally driven, right? If you look at the earnings growth in the US versus the rest of the world and emerging markets, huge disparity over the last 15 years, 16 years, right? So US companies led by the Magnificent Seven names, they've just done a better job in terms of earnings, profit margins, growth. No question about it. The question today is, are you paying up for that growth? The answer is yes. And we don't know, to be determined, whether those expectations are too high. So, right, if the US was trading at the same valuation level, Caleb, as emerging markets and international stocks today, you'd say, who cares? Then throw this chart out. But that isn't the case, right? The US is trading at a huge premium. The question is that correct premium? Are they going to grow into those valuations, or are expectations too high?
All right. So speaking of expectations, the big secret, but I think we're going to back up first, and you've got a nice analogy here. So we'll explain it. And I guess I'll call everyone's attention to that big green dot that we had to call up because it's such an outlier right in the corner.
Yeah, that big green dot is Caitlin Clark. If anyone has followed her this year, just unbelievable. And this is showing her versus the 9,718 other Division I college hoops players. It's kind of incredible there's that many college hoops players. There's a lot of teams out there. That's why I don't do the March
Makes you feel bad
stuff.
you couldn't make it, right, Charlie?
Yes, for sure. So she had over 1,200 points, over 325 assists. You can see no one even close. She broke the college record, not just for women's sports, but men's as well. She passed Pistol Pete Maravich's record in terms of total points in her career. And she's an outlier. Like, this is the greatest of all time, and nobody's even close. And what she's done in terms of the game and getting attention for it is unbelievable. You're talking about multiples in terms of ratings, and that's already translated over into the WNBA, people watching it like they never have before.
So what's the parallel?
So the Caitlin Clark of the stock market is, of course, Nvidia. You can see over to the right there, nothing really close to it, over 25,000% return over the last 10 years, and it's growing its earnings at 50% per year for 10 years. So I don't say make this statement lightly, because usually there's some historical parallel. There is no historical parallel for what Nvidia has done over the last decade, and really the last 2 years are driving that. So if you truncated this down to 2 years, it will probably look even more ridiculous in terms of its earnings growth and revenue growth and its stock market performance. Nvidia is one of the all-time greats now, and it's done something in a short period of time, going from 10 billion market cap to 3.3 trillion, that no other public company has done.
I was surprised by some of the other names at the top of this list too, but
yeah, that's a good reminder, Caleb, right? We tend to think everything's technology in terms of the best performers over a long period of time. This is showing you the top 30 stocks in the S&P 500 over the last 30 years. I love this table because of what you just said, that there's companies in there that you would say there's no way Pool Corp, this boring company that is making pools for people, is going to be in there. We got Ross Stores, we got Johnson Controls, we got O'Reilly Automotive, we got Tractor Supply, great store. But I mean, it's just, the list goes on and on of companies outside of tech. Yes, Nvidia is number one, but plenty of companies outside of the tech industry, which is an important lesson in and of itself. The fact that it's not just technology over time that drives the gains for a broad index like the S&P 500. It's many, many different contributors, and it's pretty hard to predict them in advance.
And I guess predicting them is one thing, but just making sure you have exposure to the top 3, 11, 23 is what's really important, right?
Yeah. So finding the next Nvidia, that is what everyone wants to do. I'm not saying you can't do it. I'm saying there is a chance. There is a chance, but the chance is very, very low. And if you miss that next Nvidia, this is showing you the consequence of it, because most of the shareholder wealth that has been produced in this country over the last 100 years is in a very small number of companies. So just 3 companies, you're looking at 10% of all of the shareholder wealth, 72 companies, 50% of the shareholder wealth, 966 companies, 100%. And that's out of 28,000 companies. So if you're picking any random stock you think is going to be the next Nvidia, most likely it's either going to go to zero or it's going to underperform treasury bills. The majority of companies do not outperform the market. So, how do you ensure that you own the next Nvidia? The only way to do it with any degree of confidence is to own everything. And if you look at active managers, Caleb, over the last few years, they had very, very difficult time keeping up with the indices. Why was that? Because many of them didn't have Nvidia at the weight they had it. Many of them didn't have Apple and Microsoft at the weight they had it. They thought that they were smarter than the market. They're going to put a different company in, a different weight, and that's a difficult game to play. Over 20-year periods, professional managers who are doing this all day, every day. They have a team of analysts trying to figure out the next Nvidia. Well, over 97% of them fail over a 20-year period. And a few that do succeed, the returns aren't always good. They're volatile, and we don't know whether it's luck or skill leading to that. So the only way I know of in advance, how do you own the next Nvidia? Well, if you own everything, you will own the next Nvidia. And all of the companies that are bad, the nice thing about an index investment is those bad companies go down in their weighting. They go to nothing where they're meaningless. And the companies that do well, they get bigger percentages.
Yeah, I was going to ask you, Charlie, are you a big proponent of market cap weighting? It sounds like yes.
For most of the time. And the only deviation I would say is in the situation we're at today. And I wouldn't say that you should bet against the S&P 500, but you should own something else if just 3 companies are making up 20% of the index, 10 companies are over 30% of the index. Well, now that index becomes less diversified because it's concentrated in those so few names. So I would definitely not exclude the areas that have done, let's say, terribly in the last decade, comparatively speaking, because you're going to have more exposure if those companies don't do well. You'll have the exposure if they continue to do well. Great. If Apple, Microsoft, Google, Amazon, Nvidia, if they're the big 5 in the next decade, you're going to have the exposure just because it's there already in that US index fund. But if you don't own anything else, and we have a period where they're not leading, well, now you're in trouble.
Yeah, unless one of the small companies in there with a $10 billion market cap goes to 3 trillion in that same time frame, right?
Absolutely. And it will happen, right? Not to 3 trillion, but some 10 billion is going to go up and up and up, and we don't know which one of them in advance. And this is the chart, really, like if you're just throwing darts and you're just picking stocks at random, your expectation should be, I'm going to underperform not only the stock market, but simple, boring treasury bills. So you could just go out and buy treasury bills and beat most stocks, which is kind of a crazy statistics that goes against the thinking of, well, stocks are riskier, so I'm going to get paid for that risk. Well, that's true in the broad stock market, but it's not true with the vast majority of individual stocks.
Yeah, I mean, this is such a powerful visual. When I first saw this, I scrolled back in the presentation to look at that like second or third slide where it showed the average asset class returns adjusted for inflation over time to make sure I remembered that right, that stocks were somewhere in the 9% and bonds were somewhere in the 6% or something like that. But it's just about, you can't pick one, right?
That idiosyncratic risk is real, right? When you don't have a diversified portfolio. And look how industries change over time, and what is going to be the impact of AI 20 years from now in terms of businesses. We can't predict, but it's going to be highly disruptive, right? And who will be the winners and who will be the losers of the future because of that. We can't predict that in advance, but this just shows you that it's not evenly distributed. The market's returns, it's concentrated. There's the Pareto principle, the 20-80 principle. This is way more skewed than that. It's similar to basketball players, like the attention that they get, or Taylor Swift, and like the percentage that she makes up, let's say, of all concert revenue, right? It dwarfs everything else, and so there's going to be a few companies that just dwarf everything else in the future. We don't know which of those are going to be the ones to do it. If you think you can pick those 3, all I would say is do it in small in terms of your portfolio. Maybe have a separate account. See how well you do over a period of few years versus the market before you put real money in such a bet.
And even if you pick them, you have to hold on to them for the long run, right? I
You have
mean,
to hold them. That Nvidia did that comes at a price. Nvidia had many enormous drawdowns. Nvidia, people think it just came out, but it's been around. It was around during the dot-com bubble, and of course, it got crushed during that period of time, like everything else. Nvidia and Amazon was down over 90% in that period. So a lot of those winners that we showed, if you look at the drawdowns, that's very difficult to stick with. And the other way, Caleb, as well, because we have this bias to keep our losers and sell our winners, because you always hear the saying, yeah, well,
yeah.
no one ever went broke taking a profit, right? You hear that? It's so tempting. Imagine you had 10,000 in Nvidia, and now you have a million. You're just going to sit there and watch it, grow to a few million? No, you're probably going to say, and not unreasonably say, I got pretty lucky here. I already won the lottery. Maybe I should take the chips off the table. So yeah, it's always a little bit unrealistic unless you're just buying this thing and forgetting about that you own it, that you're going to sit through the ups and downs.
All right. Well, let's move on to 4 charts hand selected by Charlie Bilello to watch for the second half of 2024.
Here we go. This is one of the same ones we used at the beginning of the year to say, if this thing reverses, watch out. It hasn't reversed. It's accelerated. This is semiconductors versus the S&P 500. This is the SMH ETF. And now we're at a new high. This ETF started in 2000, so we surpassed that peak from back then. And why is this important to watch? Because semiconductors tend to be a leading indicator for tech. Tech, obviously, biggest sector in the market. This will have an impact on large cap versus small cap, growth versus value, US versus international. This is now the big driver, all of those relationships. And it won't go up forever, but for now it's still going up. So I watch this pretty closely for any sign of weakness. We haven't seen it just yet, but you could see here the move since 2022 lows there, and really the last year and a half just going vertical here. You might say that's
Probably this is probably the fourth or fifth chart that have drawn parallels to very recent market activity and back to 99 2000. Are you seeing a lot of signs in the market that kind of mirror that time period, or is it just reflective of how well this sector and growth has outpaced value right now?
Yeah, all of those things look like 2000. In terms of sentiment, I felt like 2021, early 2021 was more like 2000, when we had just a rush of SPACs and IPOs, and we had the meme stock craze back then. But if you notice, the meme stocks are back now, and so it's not in a vacuum. Sentiment's getting bullish again, and obviously growth and value, all of these relationships are stretched. Is it the same level of mania as back then? No. We know many of these companies are real. Nvidia has real profits, real earnings. It's just a question of the multiple that you're assigning to them. So I would say for sure there's a lot of parallels. We're not as extreme as back then, but absent that period and absent early 2021, I would say this is the most extreme we've seen it. So put it at number 2 or number 3, depending on how you define it.
Yeah. And talk about yield spreads, another important trend to watch.
So this is a real important one to watch, because the big question, Caleb, for that higher for longer theme is, well, when is that going to impact corporations? When is it going to put pressure? And the assumption coming into it was they weren't going to be able to handle this interest rate spike that we've seen. And they've handled it beautifully, especially large caps. Companies like Apple, they have very little debt. Any debt they have is fixed. Low rates. They have a lot of cash in their balance sheet. They're actually profiting because the cash that they're making on their floating rate investments. You look at a company like Berkshire Hathaway has a ton of cash in their balance sheet, all in treasury bills, earning 5%. So they're loving this, right? They're doing okay. But at some point, especially, and this is one of the reasons, of course, driving that large, small divergence, when you have to refinance, when you have to go out there and issue new debt, well, it's at a much higher level. Well, that's going to at some point lead to probably a higher default cycle. But the expectations today, we look at high yield spreads, investment grade spreads, very, very tight. So the expectation is, nope, things are just fine. For now, this can change very quickly, so keep an eye on it. But for now, the expectation is, nope, high interest rates not high enough to really put a dent in terms of corporations and their fundamentals.
All right. And let's talk about the housing market.
Yeah, so housing market, same story. I didn't do a lot of housing market on this because we touched on it a lot during the
Sure.
last webinar, and it's kind of, I've been calling it the Groundhog Day housing market because it's the same thing month after month. Affordability is very low because mortgage rates are high, home prices are high, up over 40% the last few years, and inventories are very, very low because of that locked in effect where people who have low mortgage rates in their existing home either can't move or don't want to move. And that supply situation has overwhelmed, and this surprised me a ton, the fact that the decline in demand that we saw, which was absolutely crushing, right? If you move the interest rate from 3% to 8%, well, what you can afford goes way down. So as expected, the demand for homes for new home buyers collapsed, but the supply went down even more. You can see we hit a record low in terms of existing home supply. The good news, and perhaps we're right at the cusp of perhaps this changing, supply is just starting to creep up, starting to inch up here, up 16% year over year. And in areas that were the hottest markets, we're talking about Florida, Arizona, some of these other areas, you're starting to see supply really start to pick up. So this might
So
be
of all the indicators in the housing market, is supply the one that you're following closest as the leading indicator?
absolutely. I think that if you get supply back to normal levels, now we'll see what happens in terms of pricing. We know historically, Caleb, number one thing for the housing market is affordability, and affordability is very low. So if I would think if there's more houses on the market, that's going to put downward pressure on prices. And then it's just a question of A, do people still have their jobs? And B, are they getting wage increases, right? The number one thing for the housing market is people lose their jobs. Well, that's a problem, right? They can't afford to stay in their home. We haven't seen that cycle since the financial crisis, of course, not hoping for that. Of course, at some point it will happen. That will put pressure on it. But outside of that, it's the supply situation. Just because it's so abnormally low here, I want to see what happens to the housing market when it normalizes. Is there enough pent up demand to kind of offset that? Perhaps. But again, it comes down to math and affordability, where if you have to buy a home at a 7% mortgage rate, for most people, you're looking at spending 40 to 50% of your income on that housing payment. That's way, way too high for most people. It crowds out all other spending. So we'll see what happens with this summer.
All right, and I think this is our last chart. I know sometimes you sneak one in at the end, but I think we stuck to four for our four chart
Yeah,
section.
just four. I was tempted. I was tempted. I kept it to four here, and this is my favorite chart of all time because it's a chart showing you, are we moving in the right direction or the wrong direction as a country in terms of prosperity? And when we're above that zero line, we're moving in the right direction. For a long time, you and I were talking about the wrong direction, where wages weren't keeping pace with inflation, but now 13 straight months we have wages outpacing inflation. So wages over the last year went up 4.1% in the US, still pretty good, right? So the housing market is definitely, the employment labor market's definitely loosened, but not to the point where we're not seeing wage increases. So 4.1% wage increase, CPI is running at 3.3%. That spread, that 0.8%, doesn't seem like much. Well, people feel good when that's in positive territory. You compound that over time, and that's led to all of the prosperity in human history. The fact that prices for things haven't gone up in the past 100 years, 200 years, as much as people's incomes. And so their standard of living gets better. And so hopefully is a trend that continues, keeps going. And this is another reason why I say don't be in a rush to cut interest rates. Let's make sure inflation, the war against inflation has been won before we start going crazy and cutting interest rates, because I want to see this stay in positive territory.
Yeah, couldn't agree more. All right, I think I know it's top of the hour here, but I think we can take at least a question or two if that's okay with you, Charlie.
Let's do it.
All right. So one question that came through, and I wanted to tie this back to a piece of data that came out today too. Retail sales were released, were a little bit lackluster compared to expectations. But what do you think are the main signals that the Fed's going to keep an eye on for when they really do start their rate cuts?
Yeah, number one is going to be that core PCE or core inflation, core CPI inflation. And it seems like from the way he's talking, Powell, and if you watch the last press conference, they want to cut, they just want to get closer to 2%. And the driver for core inflation, the biggest driver is housing. And if you look at the housing data, it's very lagging in CPI. If you look at the way shelter CPI is calculated, and my expectation is we're going to see lower rates of core inflation in the months to come. And so that's number one. Number two, of course, would be employment. And so now we have an unemployment rate at 4%, still not very high, right? Historical average is around 5.6%. So they still have room to focus more on inflation than employment. But if that starts creeping up, let's say 4.5%, the balance is going to shift, I would say. So they're looking at employment, they're looking at wage growth, right? So if wage growth really slows as well, that'll give them another excuse to cut. Those would be the main things. The Fed says they don't look at the stock market, but we all know that they do. If the Fed sees a huge stock market decline, they're going to be more inclined, I would say, to cut interest rates. But they stuck to their guns in 2022. I have to give them credit for that as well. When people were saying, look what you're doing to the stock market, it's going down, you're causing these problems because you cut rates now. They didn't do it, right? They said, nope, we're focused first and foremost on inflation. That hasn't been resolved, so we're going to keep interest rates where they are. So those would be the biggest thing that they're looking at, just the trend in terms of core inflation. And I think it's likely to go lower. The question is, will it go low enough for the Fed to say we're confident that it's going to be at 2%? I mean, that's impossible to say, but the market's expecting that to happen in September to get the first cut and the next one in December. And that would be interesting, right? Get a cut right before the election would be pretty interesting.
So some of these other economic releases, like retail sales and the ones that aren't really affecting those headline numbers, are those pretty muted in your mind for now until?
Yeah, well, retail sales is trending in an area where the Fed would say this might be another reason perhaps to cut. And I've been talking about how if you adjust it for inflation, it's negative now over the past year, right? So prices are up. And so companies are selling more, revenue is up. If you adjust for those higher prices, the actual quantity is down. So the consumer does feel like they're pulling back. You could see because of those higher interest rates on credit cards, auto loans, the rest of it, they seem to be pulling back. And is that a reason by itself? No, but if that starts to filter into economic growth, we saw a slower GDP number in the first quarter. A lot of that stuff is lagging too, Caleb. It's like the real-time stuff that the Fed's honestly going to be looking at is that credit spread data. They're going to be looking at financial conditions. Like if things start really moving in the wrong direction, as long as they have inflation in a decent place, I think they want to cut. I think they want to cut for a number of reasons, and that interest rate on national debt being one of them, even though they won't admit to that. So I don't think that we've gotten the easing mentality out of the Fed just yet. So I'll believe it when I see it. Maybe I'm wrong, but I'll believe it when I see it.
Charlie, the Fed's biggest fan now, all the way full circle.
I want to believe them that they care about the average person and inflation. They've been saying it, so just keep it up.
All right, Charlie. I guess the last question: can you do anything to get Caitlin Clark in Paris so we can watch her play in the Olympics?
Oh, I'd love for that. Yeah, they left her off the team, right? I mean,
No.
that's ridiculous.
Tragedy. Unfair.
Yeah, tragedy. Best college player of all time. Remember when they did the Dream Team and they took Christian Laettner? A lot of people were upset that they took him, but he had just won the championship. He's one of the best college players, and similar theme. I think who did they want them to take? I can't remember now. Was it Shaq? Was left off? I think. Yeah, that's going way back.
Yeah,
test your knowledge there, but
I'll
I mean, for a million reasons, she should be on that team, even just for ratings alone.
I was gonna say I know NBC would have been happy, but
100%. Yeah.
All right. Well, Charlie, thank you as usual for joining. Thank you for the insights. Best charts out there. So appreciate it. Look forward
Appreciate
to
it.
next time. And thanks everybody else for joining us today too.
Yeah, thank you, Caleb. Always a lot of fun. And everyone have a great summer, and we'll see you next time when Nvidia passes 4 trillion. We'll see.